You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions@TheOptionsInsider.com.
Thanks again to Joe, Kamnick, and our panelists for their insights. I'm really excited to introduce the next panel. Callie Bost, who covers the stocks and options trend for Bloomberg News, is moderating the Financial Advisor panel. We have the Financial Advisors Forum running concurrently today with our general session conference. Couldn't be more pleased to invite the financial advisors to our event as well. With that, I'd like to welcome Callie up to the stage.
Hi, everyone. Thanks for joining us so early in the morning. After, some of you went out on South Beach. Other of you watched the Blackhawks win last night. Woo! Or Minnesota lose. I hope you weren't a Minnesota fan. But this next discussion is going to be one about options use in asset and wealth management, an area that I feel like is still largely exploring and experimenting how to incorporate options into portfolio strategies. Before we start, I thought it would be a good idea to go down the line and have everybody introduce themselves, give their firm name, and a brief description of how they use options. Just a 30-second soundbite. So
30 seconds.
Yes.
I'm a suffering Flyers fan, so thanks for bringing that up. Appreciate that.
Sorry about that.
There you go. My name is Mike Galantino. I run the private client group and capital markets group at Boenning and Scattergood, which is a Philadelphia-based broker-dealer that has research, investment banking, public finance, but we really have a focus in our private client group in the option world. Many of you might know Lou DePaul, who runs our desk, and we have made it a core part of the discussion with all our high net worth clients. So we'll be talking a little bit more about what we do later in the presentation.
My name is Dagny Maidman, and I work with Credit Suisse out of the San Francisco office. And I manage a team of 5 people in total, and we use options as a core part of our strategy for managing high net worth portfolios.
I'm Donna Walton with Raymond James and Associates. We are out of East Texas, and I manage a strategy that we're using in a fee-based platform that is repeatable, that will be rolling out to our financial advisors later this year.
Great. So let's talk a little bit about how you use options in your universe. What are some common trends in the wealth management space in terms of diversification, protection, and asset allocation ideas?
Well, we have our private client group we build, manage, protect, and transition wealth. And where options help us primarily is in the building the wealth and in the protecting the wealth. Risk management is very, very important to us, and we do some put writing at times. But our core focus is in generating more income for our clients. An example would be we do a lot of covered right strategies, and Lou DePaul and his team churn out ideas 4, 5, 6 times a day. And one example, I'm not supposed to give names, but like Johnson & Johnson is a good example of one of our core holdings where stock's down from 109 to right below 100. It pays a 3% dividend yield. The 10-year J&J bond is only yielding 2.55%. What we do is we find ideas like that our fundamental analysts like. We put them in portfolios, and when it makes sense during the year, 2 or 3 times, write covered calls. That's our most core strategy that we use. A lot of our higher net worth clients as well have concentrated equity positions, so we love to do cash as collars when appropriate. And the third way would be we do write puts when appropriate in names that we already want to own. I think it's important. A lot of the industry, the institutional guys out there know that we try to at Boenning and Scattergood we try to incorporate the conversation from day one when we're talking to clients about options. A lot of people, it's like the lights go on, they're like, oh my God, what is an option? And once they understand the process, once they see a couple of transactions, they get it. But it's we really try to, from the initial conversation to the initial analysis of the client's needs and wants and goals and objectives, it's something that it's a core part of what we do at Boenning.
So we use options in lots of different ways. I think that it's not that I set out to use options in the practice. It's more like options became a solution that worked very well to satisfy some of our client needs. And so we ended up kind of creating a strategy to solve an issue around 2010 with clients who had been scared out of the equity markets and really could not quite get themselves together to put money back to work in equities. And so that's when I started a strategy where we started to write puts that were cash collateralized on stocks that we wanted to own. And I think it took a little while to get the client base kind of educated in what puts are. But once they understood it and you demystified the language, maybe you talked about it as we talked about it as, would you like to provide insurance to other investors who are nervous that stocks will decline and get paid for it? And if we can select stocks you're comfortable with, is that something you would do if somebody would pay you to do that? And we were able to, I found the clients really were very receptive to it. But demystifying the language was important, I think, in articulating it. So mostly getting paid to put limit orders in, that they kind of got that idea.
And for us, it was about, it seemed like trying to make yourself stand out and look different in the world of investing with your clients. And my career spans about a 15-year span of working primarily with asset allocation models. And it's, what do you do to add value? How do you add value to your client? And it seems like there are a lot of great firms represented here. All of us have our asset allocation models. We can explain diversification through either mutual funds or ETFs. We can talk about a process. We have an investment committee that will make a decision and will allocate, and we'll use good managers that add value and use active management strategies or even passive management strategies through ETFs. And it seems to me that has become a commodity. And so how do you stand out with your clients, especially your astute high net worth clients, and solve the problem of income and confidence of staying in the equity markets? And then how do you add value through customizing your portfolio of stocks and then overlay that with a covered call strategy that generates additional income, basically as a selling point to your client, is going to cover the fee because we do ours in fee-based. And then at Raymond James, how do we then take that and make that a repeatable process that our advisors can take to their clients in a confident way? And how can you customize that for each individual client? We have a pool of stocks that we work with, but what if a client didn't want to own Kraft and they wanted to own Eaton? And so we're able to even further customize that even more. So that was our really biggest challenge was, how do we pull all that together? So formed a small team inside Raymond James and have come up with something that we plan to roll out later this year to our advisors.
Great. So Dagny touched on this a little bit in terms of demystifying the language around options. But what are some of the steps you take to educate clients who may be nervous about incorporating options into their strategy?
Well, I think Dr. J, was with him last night. I think that there's a lot more conversation about options. I think 10, 12 years ago after the 2000-2001 crash, there was a lot of bad things said about options because of guys selling puts and, hey, it's going to be fine, and going to the Mac machine every month and selling puts until it didn't work. Everybody kind of clammed up after that. But in the last 5 or 6 years, the dialogue about options in my world, we have clients actually bringing it up to us before we talk about their asset allocation and their objectives and goals. Fast money. I mean, I think a lot of people have a better feel for what options are. And to Donna's point, I think really just education and having the conversation with clients. I think, our business, the retail business, has gone almost to kind of a model, you plug and play, and you get the clients, we'll manage the money, don't worry about it kind of stuff. And I think what real clients want, what very high net worth clients want, is something different and something more. So I think options provide a dialogue, b a reason to stay in front of a client, and when they understand that we know what we're doing in the option world, I just think it raises the level for the portfolio, raises the level of the relationship, it gets us referrals. But I just think the conversation, and once they understand what's going on, they embrace it, and they typically do what we say, right, Donna?
Mm-hmm. Yep.
Yeah.
Callie, ask me the question again.
Oh, no, you're good. You actually kind of answered it in your first response. But are there any other steps you take to educate clients when they come to you and they're like, oh, Dagny, I'm not sure, options, I've heard some bad things?
Right. Yeah, I mean, you have to definitely take the language away. If you start the conversation, which I tried in the beginning to say I want to sell naked puts, that got a lot of looks. So I think actually Google's been mentioned a lot. It is really helpful that everything is available online, that somebody can check that what you're saying is true. But it took a little time to convince clients that actually, if they had cash in their account, that writing a put to purchase only the amount of stock, the notional value of cash that they had, is actually less risky than buying a stock. And, I think just listening to clients, figuring out how they understand things, and then using language that they're comfortable with is what I've done. And I've seen different people respond to various ways of expressing what a put option is. I almost never use the word put option in discussions in the early part, because clients just get this glazed look. So.
And I agree. I think keep the language simple, explain it in terms that the client can understand, talk about how it benefits the client. For example, if you're doing covered calls, it's additional income. You get to keep the dividend. That will help you offset the fee. You're still going to have an proactively group of stocks left, and it's going to be in names that your client knows. And it's about communicating with your client then, because what they're going to do is give us discretion in the account for the type of account we're running at Raymond James. But it's about regular communication with your client and being sure that they can say back to you what you have said to them. It's to stop and listen, that the client can then say to you, and they understood it, what you said to them.
Mm-hmm. So when rolling out a new strategy or product revolving around options, are there still any hurdles or obstacles you face with either clients or actually rolling out the new strategy or product?
I think there's a limited amount of strategies we all use. I don't think, like you guys talk about, the smart guys out there that do the algorithmic trading. We're pretty basic at Boenning and Scattergood, where we write the calls, or we sell the puts, or we do the straddles. I think the packaged products and the mutual funds out there that employ options on a much higher intelligence scale, where it's more complicated, that we prefer to utilize those investments for the complicated option strategies. Mm-hmm. So we kind of keep it basic, blocking and tackling at Boenning. Again, the covered rights, the selling the puts, the cashless collars for concentrated positions. And again, every client's different. They all have their different objectives. And so we try to keep it as basic as possible.
Mm-hmm. So in our book of business, we manage over $1 billion, and we have about $150 million now in this put writing strategy, which had started back in 2010 with maybe one very large client and a $10 million account. So it's been interesting to see the evolution in that it didn't start as a strategy, but it became a strategy after working with this one client and doing it more on a non-discretionary basis and in discussions. But over time, I realized that we needed some rules in order to do it effectively. Mm-hmm. We ended up writing those rules using that, using a framework for what we were doing for this one client, and then we recognized, wait a second, this would work very well across our book, and so we started talking to other clients about it, and it's worked very well. I do still have a hidden fear, given that we haven't really had a real decline since the summer of 2011, that clients don't fully understand what they're doing. but I feel comfortable with it in any case, even though I know there'll be a lot of discussions because the capital is there. But I still think, which is different than in covered calls, but that people will be surprised when there's a large increase in volatility about how their account performs until the vol comes back out of the market. So I try to warn people about that in my discussion of the strategy, but I'm not really sure if they're hearing it or not.
Right, right, yeah, good point. I think the way we're setting our particular program out is really active management. So our chief equity strategist is Mike Gibbs. He's been with Raymond James, but through Morgan Keegan since 1985. And the man lives, eats, breathes, sleeps equities. He has 3 models. He runs over $1 billion in these models. What I've done is taken his most conservative model, which is called equity income. That particular model will hold about 18 different stocks, so you've got a diversified portfolio across all your sectors of names that your client is going to know. And so for us, when talking with our clients, this is a slice of what you can do with your investments. It's not 100% of what you should do, but as you look at how you fill out your investments, if you are going to be in equities, let's be in names that you recognize that are dividend payers, dividend growers. They all have stories that you can talk about with the client that the client's going to know. And then we're going to overlay an active covered call program that you're going to give us the discretion to run as well. And so Gary Franklin, who is our option strategist at Raymond James, has developed a program to overlay the options over the equities and as a repeatable process so that as an advisor, my role is then to communicate to my client about what are we doing, why are we doing it, making sure the client understands, and that the potential exists for the security to be called away, but that's not by the design. The design is to roll that option out, even if we have to buy that option back at a loss, and then go for a higher strike price because we're trying to get the capital appreciation in the account to grow. And then once they understand that we're rolling that, they really become very comfortable with it. But I will have monthly meetings with my client to go over that statement, go over the call options, be sure that they can say back to me what I've said to them and that they understand it. And then typically they go, well, I want to put more money in this. And I'm like, well, no, let's talk about this as an appropriate part of your overall allocation. And that has seemed to work very well. So our plan is to roll this out to our advisors as a fee-based account that they can put in place with their model fee-based business in our mutual fund models or things like that, but really to attract a high net worth client and then to overlay that with financial planning and other aspects with the client where you can really show that you add value. So that's our strategy.
Gotcha. So Dagny, I'm going to put you on the spot here. So give us a little bit of perspective of, some conversations you have with clients, because you brought up a very interesting point that we haven't seen a big market decline in a while. So what's some feedback you get from clients when they're starting to think about, where do options fit in, the money that I'm putting in here? Are they worried about a market decline? Are they just thinking like, oh, maybe it's some time to, diversify my portfolio a little bit more? What are they saying?
I think my clients are less worried than I am about a market decline right now, which is probably a sign that we're closer to a market decline. So, like both of you guys, we have broader portfolios, and the put strategy that I'm running is just a portion of the portfolio. Mm-hmm. And I think that I think the most important thing when talking to clients is for them to understand the worst case scenario. And so in the situation of what we're doing, we're in the situation of what you're doing. It's not that, the worst case scenario is not that bad. Either in your case, the stock's going to get called out, or in my case, you're going to purchase the stock. Mm-hmm. And actually, we do use covered calls once we do purchase the stock, because we do sometimes purchase the stock. But I think spending time with the clients on the worst case scenario, which is, like you said, having identifiable names, strong franchises that everybody understands, that have lots of cash flow and saying, okay, so the worst thing is that you will buy this stock. And then we really focus on, we do this not on, we do it on a portfolio of stocks. So we're selling the puts on around 20 names at any given time. And we also only do it when certain rules are met. So we don't sell puts against stocks that are just moving straight up, mostly stocks that have more recently returned to their 50-day moving average and have some increase in volatility. And so I just make sure the clients understand that they may own the stock, and when they own the stock, they will not want to own the stock. Like, by definition, it will be down below the strike. And I just try and write out an example for them or ask them to, articulate the story back to me, and then we just go from there. But it is, and so right now we actually purchased 2 stocks recently, and it's been working really great. We bought Yum Brands on the pullback about chicken in China, which was a while ago at like $73, and now it's $93, and we actually sold covered calls. And so clients, I've found that over time, clients really do glom on to the strategy and the stocks that we do buy, and then have a lot of questions about that. And Emerson Electric is another stock we bought. So we'll end up buying, just big franchises on their declines, and clients will end up holding those in their portfolios, hopefully until they get a sizable gain from the stock.
So do you ever get any resistance from clients after walking them through, how you use puts and calls? Do they ever say, oh man, like this is not what I'm used to?
Well, if they do, I don't push the conversation. So I definitely respect clients' interests and wishes. But no, most people think it's like, mostly people say, why isn't everybody doing this?
Yes, absolutely. Yes, that's what they say.
And then I don't have very good answers. I sought to figure that out myself and haven't found any really good answers. Maybe if skew changes, people won't. But right now, I think there is an opportunity. I think the opportunity definitely was better.
I think you might have lost your mic.
There you go.
Definitely lost my mic. I think the opportunity was better in 2010, 11 in terms of volatility than now. But yeah, I don't push it with clients if it's not something that's up their alley.
I do think that to get people started, we start small, and we have the option book, and Alan Grigoletto and Eric Cott give us great information to get us out to our clients, our retail clients that, unlike you, are very new to the option business. But I think starting with a small 5-10 contract and then they see what happens after a month, after 2 months. And like you said, Donna, they're like, well, how come everybody's not doing this? It's the greatest thing in the world. And they don't understand the downside. I do think that if you start small, they see it in operation. They see the money from the put hitting up in the account 60 days after you sold it. That's the most compelling thing that the client can see. I also think that, to your point, it's we're on the front lines with the retail clients, and we all get wrapped up in the institutional side of the business and how smart we are and what we're doing. But it's really, we deal with fear and greed dealing with individual clients, and I think sometimes the worst thing that one of our option clients could do is buy 10 contracts of it out of the money, call, and something happens and they make 5 times their money, and that's it. I mean, the guy thinks he's Jesus, and he's going to do whatever he wants. And I think that's the worst thing that can happen to a client if it's used improperly. So our job is to educate our clients, but to control that fear and greed, like you said, when the market is down in 2009, and it's like, I just want to get out of everything. I want to go to cash, and that's not the right thing for the client. We keep them in the game. We keep them in the market for this move from 2009 through this year. And it's difficult. It's difficult. But once the client sees how successful it could be through their accounts and through their performance, it's very powerful because not everybody does it. It's a lot easier for a financial advisor to do an asset allocation model and plug in 6 different sleeves of ETFs or mutual funds and just go on and get another client. And when you work with clients on a daily basis, I think they appreciate it. I think the performance, with options is much better than the performance without options. At least that's our study. So it's more of an educational process. I do think that you start clients small, and like you said, when the client says, "Hey, I want to do this with 80% of my portfolio instead of 20% of my portfolio," like, whoa, and you got to kind of control that greed side of the discussion to make sure that they're doing what they're supposed to do for their, the retirement in 10, 15, 20 years. So.
Yeah, and I'll add to that. I think that one of the best opportunities we all have right now is that options are not widely advertised. And, of course, I watch Dr. J, too, and I love Fast Money, and I learned so much from watching all of that. But that's really where you go to get education. It's not something that you see being advertised like gold and silver. You know, at that point, it'll be over. You know, when it reaches the advertising of gold and silver. And so it really is a way to be unique and stand out and add value. And I love that right now. I love that you can go out and raise assets right now and really be different with your client base, but also still be, know your customer, have it as an appropriate part of the portfolio, have their best interests at heart. You become a trusted advisor. There's so much about cementing that relationship with that client because you're saying, no, we're not going to put all your money in this. We're not swinging for the fences. This is about, if you're going to be in equities, it's about income. It's about having the right names. It's about, reinvesting your dividend. And then the only technical thing I spend any time talking about with a client is I make them understand beta. Because the portfolio, if it has a higher beta than the market, they need to understand that. And if it has a lower beta than the market, they need to understand that too. Because for your most conservative clients, a lower beta is what's going to help them stay in the game when the market declines. That's the only technical thing that I help them understand because you do get that glazed over look if you start talking too much of the technical with them.
Mm-hmm. So, Michael, give us a sense of the kind of conversations you have with clients, because you mentioned there is, fear and greed, the devil and the angel. And do you deal, because you also mentioned that, you could have clients come in, that have played options before and, might have won, and maybe they do feel like Jesus. Tell me a little bit about the wide range of clients you have and what kind of discussions you have when you start when you propose, incorporating options?
Well, again, at Boenning and Scattergood in the private client group, we do a number of services for our clients, building, managing, as I said, protecting and growing their wealth and even transitioning their wealth. And we make it a part of the initial conversation. And the first 2 or 3 meetings, we start really by listening to our clients and what they want and what they need. So it could be 2 or 3 or 4 meetings before we get to the point where we're coming to them with our suggestions or ideas or our recommendations. So it's more of it's a transition from clients. And to Donna's point, options are like, well, I don't want to talk about it. But once they can see it, after meeting 2 or meeting 3, and then when we implement some of the strategies in the portfolios, they really embrace it. Some of them watch TV and come up with ideas and say, hey, and they call up and say, we want to buy 50 contracts. This is going to take it. We don't want that business. It's a very compliant business. Compliance is very, very tight, as it should be in options, because I do think they were abused back in the late 90s and early 2000s. So the levels of clients' sophistication is up tenfold from 2000. But I do think that we need to continually have the conversation and as they said, try to temper the expectation for the client. And when they do get a little off the rails from where their strategy is to kind of bring them back. And sometimes that's a tough thing to do because they call up and say, hey, buy 50 contracts. Okay, and it's not in their best interest. It's not in our best interest. And quite frankly, long term, our reputation, we've been around for 100 years. We don't want to spoil that reputation. So we walk away from some business at times that doesn't make any sense for us when people get way out of line in what their goals and objectives are, but we try to keep them, kind of in a tight rail on what their objectives and goals are and help them get there.
Steer them. So Donna, going to put you on the spot now. Could you explain a little bit about how you not incorporate, but how you use Raymond James Options Desk support and research ideas in your strategy?
Sure. I already mentioned Gary Franklin. He is our option strategist. He has developed a easily presentable one-page document that when you place these options on the stocks that are in the portfolio, it will give you all the metrics that you need to explain to the client. But the most important one to the client is the upside if called away. And that is an easy column to focus on with the client in a covered call, is you're looking at the price of the stock where it is, you've written the call up, and you want to be able to communicate you're going to have an 8, 10, 12% upside if called away. And generally, if you can say a high single or low double-digit return consistently, and then if the stock pulls back, you keep all the premium income, a client can understand that. Mm-hmm. For us, it's about a process that is repeatable, is truly a process that's scalable in your business. And so to be able to go out and raise assets under the 3 different models and know that there's going to be oversight over both your stocks and your options has absolutely been critical. You can customize your portfolios with clients, and we do that, but it is really having that repeatable process to allow you to go out and, as my role, to raise the assets. And then Gary and I we were visiting over a year, once a week, literally going through every option and every portfolio to be sure that we had it right. And now we're able to do that around 1 to 2 times a month. And it's our options desk that's actually rolling the options in all of my clients' accounts. And so that makes that scalable. And that has been extremely important now that we're ready to roll it out. And you can say as much as you have a defined process in asset allocation models using mutual funds, you can have that similar process using options. And then you spend more time educating your client. And definitely a plug to the OIC for their website, for their education, the materials that are on there. We've had materials, you will have to have your materials FINRA approved that you share with your clients. But a 1-page, what is a covered call? That is so important to a client to be able to say, here's your homework. I want you to take this home, read this, and then let's have another discussion that you're able to tell me what you learned after you read this. And then you're raising your client's education level. They're becoming a more confident investor. It is really, I think, a very beneficial relationship. And like Dagny said, we haven't been through a pullback yet. So that's when you'll shift your conversation to look at the premium income that we raised here, look at the dividend that's supporting you and your lower beta portfolio that's supporting you from a down market. Mm-hmm. And I often tell my clients this all the time. It is not the end of the world until it is the end of the world. Otherwise, it is a market correction. And if it bothers you, please turn off your television, do not open your statement, and I will call you when it is time to do both of those. Turn those back on and open those up. And if you're that nervous, you hired me, you trust me, let's, stick in this together. I just absolutely do not let people jump off the emotional cliff. I just won't let them do that. I just absolutely forbid them to do it.
I think that's very wise. So can you tell me a little bit about how advisors can strengthen their offerings to appeal to clients, thinking about maybe, incorporating some kind of options into their
We have, I'll also echo what Donna said about the OIC. They provide us with, working at a relatively small firm, we're less than 200 employees, not a big Raymond James or the Morgans or the UBSs of the world that have expansive option groups inside the companies. So we really rely on Eric and Alan and what they do. So the education side is big. But from a strategy standpoint, from what our clients want, like you said, it's really easy, as I said earlier, for I've often said that when you go into 5 different firms and you say, this is my objectives and I have $1 million I just inherited and I got these kids going to college and I get this one, they're going to come back with generally the same pie chart, right? It's going to be the same thing or relatively the same thing. This much in large cap growth, this much in large cap value. And I think it's the advisor's time to either step up or just basically give the basic pitch, which is you're going to be asset allocated. They're never going to make a lot of money, but they're not going to lose enough to get sued. And that's what I say to my compliance guys that we have 4 at the firm. But when the advisor takes it to the next level, because Donna makes 1% on an account, and she makes 1% on a stagnant account that doesn't do options, and she makes 1% on an account that doesn't do options. So it's the advisors out there that, again, through the dialogue of the TV and the OIC and Dr. J and everything that people are talking about it, but it's a lot of the advisors out there are too lazy to do this, and they would rather plug and play. And if they like covered rights, they understand it, it makes sense for them. They might just buy a couple of closed-end funds that are trading at 9% discounts and employ that strategy and not go through. Donna's in on Saturday mornings going through 200 statements saying where am I at risk here? What do I need to do? It's a lot of work. And to your point on the service side is big. We have a desk of 4 people that basically spoon feed my advisors ideas every day. Mm-hmm. And the Monday before expiration, we get a list of all our options, what you're in the money, what you're not, where we're going to roll, because we like to roll the week, a couple days before expiration to try to get more premium. And it's a lot of work. I mean, it's a lot of work. So again, back to the advisor. Do I just plug and play and move to the next client, or do I really become a student of options? And again, when really wealthy clients understand what you do, they're stickier, they're happier, their performance typically is better. They give more referrals because I think the retail industry in our business has gone a little vanilla, for lack of a better word, because of compliance restrictions and because everybody's got to be in the same narrow band in terms of options for their clients. But options, I think, makes us different. And a lot of clients that have accounts at other firms, they don't have that conversation. That's a differentiator for us and makes us hopefully special.
Mm-hmm. Great. So tell me a little bit about some evolving trends you've noticed in maybe you or your peers, using options or expanding their options offerings. Have you noticed any strategies that you've just said, whoa, like, why didn't I think of that? Why didn't I think of that? Or, whoa, I'm not sure if I would want to, touch that, especially given that volatility is creeping back into the market.
Well, I might just be taking this a slightly different direction, but so I think we were talking about how options can add value in the practice, both in helping to bring assets in and attract clients and then keep them sticky. But then in talking about options in the practice, something we haven't talked about, which is maybe the downside of using options, which I want to address a little bit, because in a straight-up market, when you're selling puts, you are going to only be able to make the premium. Mm-hmm. And so one of the things that is often part of the discussion I'm having with clients is, they love the idea of the strategy at first, and then when the S&P's up 13 and they're up 4, they're like, wait a second, what now? So I think, and with covered calls also, I mean, and they're not very tax efficient strategies. Mm-hmm. True. And so these are things that I think are important to share with your clients. And then in working at a large firm and dealing with compliance, one of the things that I've found to be very effective for clients who have big retirement accounts is options are really fantastic in those accounts.
Absolutely.
And so we try to focus the strategies there. So, and in that way, we can use options as another way to create income at a time when fixed income is offering such low yields.
Mm-hmm.
Yeah, very good point, Dagny, because the IRA account is the perfect account to run a strategy like this in because of the tax. You're just trying to grow that account, slot it in and it's long-term. Mm-hmm. You're going to take that money out on a after age 59 and a half basis. The other thing I wanted to go back to on the education is for advisors really who want to incorporate this into their practices is definitely take advantage of the OIC. 3 years ago, when I got really interested in this, Alan actually drove to my office and gave my associate, Kelly Flores, and I a one-day class on options and did it so that we could grasp it and understand it. And the OIC is an absolute, they do seminars, webinars, the information is exceptional. If an advisor really wants to elevate their practice, that should be your first stop, is the OIC, because the education is exceptional there. And it's a very easy thing to do. But like Michael says, I think advisors have gotten complacent with the fact that they can build a practice in a fee-based account that's a model managed by their company, and they get a certain level of assets, and then they don't look to add value. But you're right, the referrals are there. If you're adding value through creative strategies like this that, just are not particularly well known.
Mm-hmm. Great. I don't think I have any more questions, so I guess we'll open it up to the audience. Does anybody have any questions for our panelists?
The stock, do you show it as a lowered cost basis to the underlying security, or do you show it as income? And what are the rules, the current set of rules in dealing with that and demonstrating that to the client?
Dagny.
Well, of course, I have to start out, since we're in a regulated industry, by saying I'm not an accountant. So But with the put strategy, I think the cost basis is lowered by the sale of. If you end up buying the stock, I think the correct way to account for it is by lowering the basis, which is great. And otherwise it's just income and it's fully taxable, which is why it's a lot better to do in a tax-exempt account. And I do find it surprising that institutions don't do it more, given their tax-exempt status. It seems like they could really use options to enhance returns in a variety of ways.
Yeah, agreed.
Yeah.
Great. I think we had another question over here. Gary?
This is an opportunity to say thank you to Alan and Eric and everybody at OIC. We don't get an opportunity enough to thank them as a group, and so I think we should all give them applause for everything that they're doing for us.
Well, and one thing while we're getting our next question that I wanted to add about Eric and Alan is they formed our leadership council a year or so ago, and they invited a number of advisors to come in and have input into education and leadership. And Eric and Alan made a real concerted effort to be sure that women were represented on that particular board. And as you all know, women advisors in the industry are a small part of the industry, probably less than 15% of the industry. And I will share with you an observation that Eric made. He actually shared this story with me this morning. He was actually out walking on the beach this morning, and he told me that the clouds parted, and he heard this absolutely loud voice say, "Eric, you're a good and righteous man. I'm going to grant you a wish." And Eric said, "Oh, that's awesome." He said, "I've always wanted to go to Hawaii, but I'm absolutely afraid of flying. You're going to have to build me a bridge to Hawaii so that I can get there." And the loud voice, the Lord said, "That's absolutely impossible, Eric. You're going to have to wish for something else. The logistics of that will never work." And Eric thought for a minute. He said, been married a couple of times. I really want to understand the heart of a woman. I really want to understand how she thinks and feels and what goes on in her mind and what will make her happy. And after a very short pause, the Lord said, "Would you like that 2 lanes or 4? No, Eric's been great. Alan has been great. Lots of education. And I really applaud them for reaching out and helping women raise their education level to stand out in the industry.
Mm-hmm.
I have kind of a 2-part question. First one is, do you find any particular demographic to be more or less receptive to using options, whether it's a traditional demographic like an age group or income level, or simply their background, people who lost money in previous corrections, made money in previous corrections, something like that? And then the second part is you mentioned women being historically underrepresented in the industry. Do you find yourself using any different language when trying to explain options to, a man versus a woman?
I'll take it, yeah. The answer is no in the last part of your question, no different language whatsoever. I will tell you that I find women to be more apprehensive, and I have to actually lean over the table and say, "I've got your back on this. I want you to try this. You're not getting married to this strategy. You can stop it at any time. We're going to spend a lot of time communicating and educating to be sure that you understand it. And I want you to at least experience this and try it." So I will say that's probably the difference. When men get it, they're compartmentalized a little bit differently. They get it, and they want to put all their money in it immediately. That's the difference right there. And so I think that the demographic, the age group, for me, I'm working with more, my minimum is $1 million in my particular strategy. So I'm working with high net worth individuals that have this as a slice of something else that they do. And what we're doing is to try to set that off to the side and explain it to them. That tends to be people that are in their 50s and 60s that have accumulated that kind of wealth. I really haven't had the opportunity to work with any young wealthy, maybe entrepreneur types. But I think that would be very exciting. So I think there is real opportunity out there to bring at least a covered call strategy across many demographics.
Yeah, I agree. I think that when you talk to women control way more than half the assets out there, fellas, so we're in trouble. And Alan, I think Donna's kissing your butt a little more than me. She's doing a great job. But he has women and Italian on this leadership council, so that's good. Thanks for that. But to your point on the demographics, the 50, 60-year-old client, typical $2-3 million client, is employing a totally different strategy than the 30-year-old guy who works for a tech company who needs to hedge his portfolio. I do think like we heard this morning downstairs in the private client breakfast, the universities, Notre Dame, Villanova, NYU, I mean, these kids are coming out of college now with a working knowledge of the option business, which never happened before. I mean, 15, 20 years ago, you'd have to get in the business and you'd have to trial by fire and you'd lose some money in some options, like how does this work? And then you'd figure it out. I think the education, through the university system and through the industry groups, represented here, it's phenomenal. So I would say that in our demographics, like the 55, 60, 65-year-old that does the covered right strategy, and he wants some more income, and he wants to make that Johnson & John look more like a bond, and that's kind of the strategy there. The younger guys want to get a little more aggressive, and every client's different. We do have clients in their 60s that want to be way more aggressive than even more comfortable with, and then we also have the 28-year-old guys saying, I read about Bernie Madoff. I'm not putting any money in the market, and it's pulling the kid out of the the hole that he's been in. I saw 08, 09, and I'm not going to put any money in the market. And then so it's more of a psychological thing than anything else. But every client's different. I don't think there's any one demographic, but I would say the older clients, they need income. They want more security. They have less time to retire, less time to have that money work for them until they retire. So they employ way different strategies than a 30-year-old kid.
I was trying to think in my practice if I've seen a difference in terms of the interest or uptake in using option strategies across different. The demographic is all very wealthy, but across different age groups, and I don't think so. But most of my the average age of my client is in the mid-50s, and I've seen. I think that a few clients I have that are kind of over 70, I don't think that there's been that much interest, even if I've tried to explain it, and so I haven't really pushed it. And then with folks, men and women in their 30s to 60s, if they get it, and they're very attracted to it. And we also, I've been talking about the puts, but we use covered call writing as well. But it's interesting because if you're employing this a put strategy, then one of the things we do is we really don't want to cover the upside for the long stocks that we're in. So while you can use them both in an income strategy or in a tax-exempt account if you're willing to just buy back the stock, I really do think buying and holding stocks for the long term actually benefits individual investors probably more than anything. And so the issue that I have found, and maybe this is the market that I'm in where there's a lot of acquisitions and they're cash acquisitions, is that people are concerned. They're still concerned 7 years after the crisis about getting invested. And so the tool of using, of writing puts that are collateralized is still something that is, and for younger people, is something that can be an entry into the market. And then that's sometimes the first thing that we're doing. We're doing that for like a year and then can have a discussion of like, so now do you think you could just buy a few stocks? So that's kind of how we get.
Any other questions?
I have one question. Kevin Lund with T3 Custom. Curious, do you, first of all, I applaud all of you for implementing the option strategy. It's sort of our utopia here for everybody in the room, I'm sure. I am curious, as the volatility starts to increase, do you have volatility triggers that you're using to maybe dive a little deeper into strategies like, instead of selling a naked put, perhaps selling put spreads to protect that downside? Because even when volatility picks up, when a market's long in the tooth, even a Procter & Gamble can suffer a 10% crash overnight. So what kind of strategies are you implementing to prevent something like that from happening?
So it's a great question. And built into we have a set of rules for the criteria to select stocks, and then we have criteria for when we will sell puts, and volatility is one of the parameters there. And we sell puts that are 7 to 10% out of the money, so one thing. And we can roll the put. So if vol really expands, we can roll the put forward. But we are, I think that, and this is where I think most options professionals and people who really use options for a high net worth investor differ, is we really want to own the stock at the right price. And so that while there'll be an expansion in volatility, my discussion at the time will be more about the fact that they should forget about the value of the option and just look at the strike price. And that's where we're going to own that stock, and that's a stock that we wanted to start accumulating at that price. And so I'm only worried about volatility in that the mark to market for the client before they purchase the stock, I think, could be problematic. But I'm not really worried about the expansion of volatility causing us to get put, because I want to get put. So in 2011, we bought 35% of the portfolio. And then in January 2013, I sold that portfolio of, it was about 7 stocks, up around 24% on average. So that's how it's supposed to work. So it's a little bit of I've found when I discuss with options professionals, they always want to protect the downside, and I completely understand that. But it's just, that's like saying for every long stock I buy, would I buy a put, is the way I look at that.
And we rely on our strategists for that information. When the VIX, when some of our names are in the mid-20s, high 20s, an opportunity to sell it, we sell it. When the VIX gets down, we're advised, it's not worth, in the call side, selling it at that point. So we rely on the industry. We rely on our own internal strategists to tell us when to and when not to do a certain transaction.
And we're totally different. We're on the covered call side. So the premium that you earn on the call is going to be a buffer to the downside, and that's how it's explained. It's that simple for us in terms of protecting that.
Mm-hmm. All right, we might have time for one more question, if anybody has a burning question. Okay. I want to...
Yeah, and the question was, if the market drops precipitously and it's down, are you going to continue to sell covered calls? Did I get that right? Yes, that's exactly what we would do. We would sell further out of the money to give us some upside, but we're going to constantly be finding that right strike price, and that's actually what the options desk brings to our particular strategy. That is what they are doing every day, looking at all the technicals of options and deciding what that right strike price should be. And again, that's why it makes sense in an IRA account.
Great. Well, I guess that about wraps it up. Thank you again for joining us, listening to us, and enjoy the rest of your time in Miami. Go Blackhawks.
Thank you, Callie, and everyone on the panel. It was very insightful for us all, and we definitely appreciate your time. I would like to invite everyone to the exhibit hall for coffee and snack break. And just as a reminder, please be prompt upon your return for our keynote speaker, Kenny Thomas. I know you won't want to miss him.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.